what is repo rate? How does it affect aggregate demand in the economy? How does it affect the money supply in the economy? How does the central bank under monetary policy influences the repo rate to control inflation and deflation in the economy? In this video, we'll be discussing all these topics. Number one, what exactly is repo rate? Repo rate or EPO. Repo rate is the rate of interest charged by the central bank. In India, it is RBI, Reserve Bank of India, on commercial banks in case of short-term loans when they need money for the short term. Repo rate is the rate of interest charged, is the rate the central bank charges in the commercial banks when the commercial banks take money from the central bank for short-term needs. Repo rate is the rate of interest charged by the central bank, RBI, Reserve Bank of India in India, charged by the central bank on the commercial banks when they borrow funds or money for short-term needs. Well, when the commercial banks borrow, they have to put some securities with it, with the central bank, or they have to keep some eligible bills of exchange with the central bank to get these short-term loans from the central bank. How does it help, repo rate, to control inflation in the economy, to control aggregate demand? If the central bank increases the repo rate, if there is excess demand in the economy, if there is inflation or rise in prices, what does the central bank do? The central bank increases the repo rate. When the repo rate is increased, automatically it will have these effects. What are these? Number one, when the repo rate is increased, automatically the borrowings, the commercial banks take it from the central bank, will the borrowing rate will go up. They have to borrow at high rate of interest. So when they borrow from the central bank at high rate of interest, obviously commercial banks will also be charging on their customers, either households or the firms, a high rate of interest. So the effect is it will discourage borrowings in the economy. People won't borrow money from the banks, firms won't borrow money for investment purposes, households don't borrow money to buy goods and services. As a result of this, the demand for goods and services will come down, aggregate demand AD in the economy will come down. When AD comes down, automatically the price of commodities in the economy will come down. We can control inflation in the economy. So that's exactly what happens. Now let's see the other way around. What happens when the central bank or the Reserve Bank of India decreases the repo rate? When the central bank decreases the repo rate, it will have opposite effect. What it means, automatically the commercial banks, what they borrow money, when they borrow money from the central bank, the rate of interest will come down. The commercial banks borrow money at cheaper rates. When they borrow at cheaper rates, obviously they decrease the rate of interest which they give it to firms and households. When the rate of interest decreases, obviously the borrowings in the economy will go up. Firms will borrow more money from the banks so that they can do more investment. Households also borrow money from the banks to buy. Car loans will increase, house loans will increase, and home loans will increase. And also they buy all kinds of luxury items like refrigerator, micro ovens, cars, TVs, computers, laptops, mobile phones, all these things. The demand for them will go up. Automatically aggregate demand in the economy will go up. So we can control deflation. So once if they go up, then the production in the economy will start. We can revive the economy once again. So I repeat once again, all the 3 points. What exactly is repo rate? Repo rate is the rate at which the central bank of a country, RBI in India, lends money to commercial banks to meet their short-term needs. The central bank advances loans against approved securities or eligible bills of exchange. An increase in repo rate increases the cost of borrowings from the central bank. It forces the commercial banks to increase their lending rates, which discourages borrowers from taking loans. It reduces the ability of commercial banks to create credit. A decrease in the repo rate will have the opposite effect. What it means? If the central bank decreases the repo rate, the cost of borrowing from the central bank of the commercial banks will come down. Then the interest rate of the commercial banks will come down. People will borrow more money in the economy. So automatically the demand for goods and services in the economy will go up, aggregate demand will go up, and we can control the economy. We can control the deflation. So it helps, repo rate helps both in case of inflation in the economy, deflation in the economy, or inflationary gap in the economy to control and deflationary gap. I'm sure you must have followed it. So repo rate is the rate of interest or the money the commercial banks borrow from the central bank at for short-term needs. So then a big question comes here: what is the difference between bank rate and repo rate? Well, both are automatically, though almost same. Bank rate is the rate of interest charged by the central bank on the commercial banks for long-term credit, for long-term. And the only difference is bank rate is for long-term, whereas repo rate is the rate of interest charged by the central bank on the commercial banks for short-term credit. That's the only difference. The impact is absolutely the same in case of inflation and deflation, inflationary gap and deflationary gap. Money supply, when the repo rate increases or bank rate increases, automatically money supply in the economy will come down. When the bank rate or repo rate decreases, money supply in the economy will go up.